But first, did you know that even top companies like Coinbase struggle with talent retention, averaging just about zero point 0.8 years, so under 1 year? Web3 faces a big problem with unqualified applicants, some scammers, overall CV spammers, leading to short-term hires. Applications like Passion, they are misaligned with the project ethos. This disconnect reduces long-term commitment to missions and goals. Well, Arbaito fixes this. Arbaito is a limited membership Web3 jobs platform that combines AI tools, vetting, and job management tools, as well as third-party ad boosts. We are maximizing the number of eyeballs on your job post. Join today by going to our link tree in the description and look for arbaito.io. But before that, hey listeners, we get it. Sometimes you've got questions and browsing through endless FAQs just isn't cutting it. I mean, we do have Discord and Telegram where you could ask us questions directly. We're very responsive there. But maybe you want to hear human interaction for something important. A lot of people value that, especially those who are, on the elder side. We get in the universities, there are elder professors. So why not make it easy on yourself and give us a call?
Yes, just pick up the phone and dial +44 0161 399 4283
from 9 a.m. to 8 p.m.
Hello, ladies and gentlemen, and welcome back to the Pipe GDAO podcast. I believe this is episode 20 now, and I am, of course, your host, Noodle. And today we're going to be, as always, exploring the frontier of impact driven Web3 innovation, RWA tokenization, and the mechanics behind tomorrow's financial infrastructure. So today we're doing an episode which is titled RWA without tokens, PGF Launchpad's answer to the OM crisis, or 0M, or OM, whatever you want to call it. So yes, today we're talking about that, and let's start obviously with the crash that's been heard around the DeFi world, which is the OM token, which dropped from over $6 to just 0.37, which was a staggering 90% plunge in under 24 hours. According to the crypto briefing, the collapse was triggered by forced liquidations and suspicious OTC token sales. But the real controversy came from the allegations that the Mantra DAO team controlled 90% of the token supply, something that undermines the very idea of decentralized governance. One viral post by Board to Boar on X labeled it a rug pull, reigniting long standing concerns about the project's transparency. It wasn't the first red flag, however, because back in 2023, a Hong Kong court ordered Mantra to disclose its finances after investors or an investor lawsuit pointed out towards mismanagement. So, what we're looking or looked like a community driven DAO, which was backed by a token economy, was possibly controlled by insiders from the start. So, why did the OM initially gain hype? It was obviously part of an early DeFi boom, which launched during the DeFi summer of 2020, which helped gain traction quickly. Community governed narrative, it pitched itself as a DAO, aligning with the decentralized ethos. Multi chain ambition, OM was locked into Ethereum. It aimed to be interoperable across ecosystems like Polkadot, and then strong marketing and partnerships. So the team was active on social media and sought partnerships with other DeFi protocols and platforms. So why did it fail? There wasn't a singular fail event, but rather a slow decline, and here's why. So it was over promises and under delivering. So the Mantra DAO claimed big ambitions, cross-chain functionality, a full DeFi suite, and governance. However, the delivery was slow and products didn't gain significant user traction. Two, token inflation. So the OM supply expanded through rewards, staking, and farming incentives, which diluted value. Many early investors crashed out, creating sustained sell pressure. Three, DAO in name only. While it pitched itself as a DAO, many community members felt decisions were still made by the core team. This created friction and weakened community trust. poor market fit and competition. The DeFi space became crowded quickly. Competitors like Aave, Compound, and Yearn had better tech, better communities, and more integrations. So OM's product were relatively generic and didn't offer strong reasons to switch from more established protocols. And then a lack of real demand. Beyond governance are staking there wasn't strong demand for OM. Speculative demand faded as price declined. And then market conditions. The broader crypto market downturns in 2021 and 2022 didn't help. OM never really recovered after the initial 2020 to 21 DeFi boom. Was it a rug pull or a scam? We're still not sure because no major fraud or rug pull event was ever tied to OM and Mantra DAO. It was more of a classic case of overhyped DeFi projects that didn't gain traction rather than outright malicious intent. But then this brings us to the role of utility tokens in DAOs. To understand how this could happen, we need to talk about utility tokens. So, in theory, utility tokens are designed to power decentralized governance, pay for platform services, and reward engagement. But here's the catch: they don't represent legal ownership and they don't guarantee a share of revenue. They're tools for coordination, but often get mistaken for investments. In DAOs, they provide token weighted voting. The more tokens you hold, the more say you have. That's great in theory, but in practice, the whales win and the communities lose. When a DAO team or early investors hold a massive share of tokens, it creates soft centralization, where decisions look decentralized but control remains internal. And when token prices spike, as they did with OM, DAOs then become a risk or become of risk of becoming speculative playgrounds where the mission gets lost in market noise. Now, here's the contrast that comes in and why the conversation matters. In the real world asset or RWA space, some dApps are intentionally avoiding utility tokens altogether. So that's where we come in with the PGF Launchpad, which is developed by, of course, us, the Pipe GDAO. Rather than issuing a volatile governance token, our Launchpad tokenizes real world university IP as NFTs, uses security tokens where legal rights are involved, and pools capital in USDC, a stable dollar pegged asset. So instead of governance tokens with little in streak value, you get parent or patent tokens as NFTs, licensing rights on chain, and revenue sharing built into smart contracts. According to Chainlink's RWA primer, this model reduces complexity, legal ambiguity, and volatility. And crucially, it doesn't rely on speculative token demand to survive. So let's do a side by side. So the token model or utility token or side by side model of Mantra DAO or OM compared to the PGF Launchpad. So the Mantra DAO's token model was a utility token, whereas the PGF Launchpad, has no utility token. The Mantra DAO had no asset backing, whereas PGF Launchpad is tokenized university IP as asset backing. Liquidity, Mantra DAO had a native token. PGF Launchpad, USDC pool. Governance, token weighted centralized with the Mantra DAO. And PGF Launchpad had NFT and project based participation. And the risk exposure with Mantra DAO was token weighted, volatility and then whale control. Whereas with PGF Launchpad, the risk exposure was stable coin based, asset linked. By removing the utility token, PGF avoids OM's fate. There's no need to prop up token value or manage inflation. Value comes from the real assets, licensed innovations from labs, professors, and startups. That's not just more transparent, it's more resilient. So, what does the future look like for RWA dApps? Tokenizing real world assets from patents to real estate is quickly becoming one of the more promising DeFi trends. According to Transact, RWA tokenization offers greater liquidity for traditional illiquid assets, stronger compliance mechanisms, and trust grounded in legal enforceability. Pipe's PGF Launchpad is early, but the signs are clear. R&D backed assets are more stable than utility token speculation. The ecosystem can grow without a governance token, and the structure supports institutional grade participation. We're witnessing a shift from tokens that merely signal decentralization to frameworks that actually deliver it. So, what have we learned? So, with the OM crash, exposed the fragility of utility tokens in decentralized ecosystems. It shows how centralized control, even tokenized form, can lead to catastrophic loss. Meanwhile, platforms like the PGF Launchpad offer a glimpse into the asset backed, mission aligned DeFi can look like, with no need for a speculative token. If Web3 is going to scale responsibly, it has to learn from these failures and build around real world value. So, what can this look like? Obviously, the PGF Launchpad, if you want to go and take a look at what a kind of opposite the Mantra DAO, token model which has no utility token, tokenized university IP, liquidity backed on a USDC pool, then you can visit the Pipe launchpad.thepipegdao.io to see how you can support the next gen R&D through real world assets. You'll want to go to the Launchpad, click invest, and you can scale through all of our real world asset projects and see we've done many podcasts on the project, so please go and listen to the podcasts back, because we've listed quite a few projects now and they're really interesting. A couple podcasts we've done on them. We've done one on earthquakes, a system which will predict earthquakes. We've done one on boosting electric vehicle batteries, improving the functions of electric vehicles. And we have also done one on AI-based solar power, which basically is a project that AI can help reduce the waste in solar power, solar panels, and use that energy towards making, I guess, more energy, more electricity, which is really interesting. So sorry, cut out there. So yes, as I was saying, please go visit our Launchpad. And as always, I've been your host, Noodle. I hope you enjoyed and are looking forward to the next podcast. Thank you very much and speak to you all soon.
But before we continue, are you looking to invest in real-world asset innovation IPs? Maybe one coming from a university? I'll have you know, they have an average ROI of 397%, aka X4. And did you know, the likes of Gatorade and Google actually came out from universities?
Then what you're looking for is the Pipe GDAO, a community-led protocol that fairly openly and honestly governs overall community ownership of the various protocols it creates. Join the Web3 real-world asset revolution powered by PGF Launchpad, with cutting-edge university laboratory inventions that could change the world with your support, bridging the gap between university IP real-world assets and Web3 capital. The PGF Launchpad connects EU university lab innovators directly with retail investors on the blockchain, included but not limited to automated seizure prediction and prevention, and boost EV driving range significantly. This could be up to 70%.
You can join us by going into the link tree in the description, launchpad.thepipegdao.io.